Hi, and welcome back again to Tim Bigham's Big Time Option Edges and Hedges. We'll take a look today at why I think gold stocks are a better way to short gold itself than actually shorting the physical gold. As always, we like to bring in a bunch of different approaches here, combining fundamental, technical, and probably most importantly, IV implied volatility analysis to get a probabilistic edge in the trade. Doesn't guarantee it's going to be a winner, but if you continue to put the odds in your favor, position size properly over the long haul, you should do just fine. And of course, getting out when it's time to get out when you're wrong. So let's jump in and take a look. First of all, here's one of the scanners I use. You can see from Friday, GDX by far the biggest unusual option activity volume on the day, as over 3 million option contracts traded versus the average of about 160,000 or so, about 18 times the normal volume. So big time volume. We'll see in a second, mostly on the call side, as GDX traded up to fresh new all-time highs. Gold was up as well, but it's not quite back to the all-time highs we saw just a little while ago on gold itself. You can see IV actually came down a little bit, dropping, which with gold and oil and some of the commodity related names, normally you see IV jump when those stocks go higher, not lower, unlike most traditional equities where you see the VIX pop when the market sells off. Here, the gold, oil, silver stocks all tend to have a IV increase when the stock increases, but the first time in a while we actually saw IV heading lower. What does that mean exactly? Who knows? We'll find out in the long run, but certainly a little unusual. As we said, we like to look at the valuations always. Here I brought up the GDX index, right, or ETF, right? It's the major gold miners, the top four components, right? Here you can see Agnico, Newmont, Barrick, and Anglo Gold comprise about 25%, a touch more of the overall ETF. So certainly those carry a pretty good weighting. So I pulled off the kind of PE ratios on all of these. Here you can see Agnico, the biggest component, right, heading towards the highest PE multiple we've seen over the past 6 months. Maybe not at that high level approaching 28, but getting there at well over 25. As we kind of go down the list here, you can see Newmont number 2 on the list as far as weighting, right, now trading at the highest PE multiple over the past 6 months, nearing 16 times. So stocks getting richly priced even after earnings, right, which were good earnings, right? So the multiples increasing here on stocks. You can see Barrick also nearing the highest level at 22 times, right, back in September 22nd, as it approaches 22x again. And then finally, Anglo at by far the highest multiple, nearing 17 times, right? Previously, it kind of stalled out at 16 times. So certainly valuations getting rich, which favors a pullback in the stock. Interesting to note too, I like to do the comparative to actually GLD, right? So here I pulled off a 3-year comparative, and you can see for the most part until just recently that GLD and the major gold stocks, right, the GDX, tend to be highly correlated, right? Anytime you saw big divergences, for example, here in the gold, where GDX kind of outperformed GLD physical gold, you almost invariably saw a reversion back. And conversely, down here, when GDX was trading too low compared to the price of gold and black here, you saw a reversion back up. And you can see that's kind of worked every time. Even the last time, which was when GDX hit the high, we'll see in a second, it had a 70% 3-year outperformance, right? And then had a big reversion back, right? But you can see since then, GLD, gold, physical gold, has not broken out to fresh new highs, right? Approaching it here, but you saw GDX, the gold stocks, absolutely ripping to new highs. So that previous kind of 70% 3-year outperformance that led to this big pullback in both gold and gold stocks, right, is now at 86%, right? So since GLD hit a new high over 400 back here on October 20th, GDX is up another 10%. GLD is actually a little bit lower, down about 3%. So we look for, again, that big divergence to revert back towards the mean, revert back to the more normal shape where GDX and GLD have a big kind of, comparative performance here, right? Highly correlated, right, for the most part, obviously, since gold stocks are very much dependent on the price of gold. So you can see here again, getting a little bit out over the skis, which favors, again, a pullback. Will guarantee it? No, of course not. As we talked about on the technical side, we like to look at the technicals. Here's GDX, right, which is getting a little bit overbought, hit a fresh new all-time high on Friday, getting back up towards overbought levels, which in the past have kind of signaled pullbacks. MACD getting a little extreme. Bollinger percent B approaching 100 again. So things not crazily overbought, but certainly getting overbought to say the least. But most importantly, we'll take a look in a second. Implied volatility is actually dropped sharply, right? You can see the last time we made a new high, IV at a big, extreme here, right? So this rally on the GDX led to higher IV. This time, the rally to fresh new highs actually caused IV to drop. We can take a look at that in a second here. And what does lower IV mean? That means option prices are cheaper, right? Both puts and calls, which sets up ideally to kind of buy some puts, right, which are comparatively cheap, right, compared to where they have been normally, with the GDX at all-time highs and at a big premium to gold here, and overvalued on a fundamental basis. So you can take a look. Here's the general 60-day implied volatility. You can see starting to weaken here. You can see that from the previous day to Friday, right, has dropped fairly significantly. So a nice drop in the IV means option prices are cheaper. Here you can take a look. IV was trading well over 40, now right at 40. So certainly getting cheaper, not at the cheapest level by far, right, but certainly getting pretty cheap here. Here you can see the move from Thursday to Friday across the term structure volatility, right? So every expiration showing a big drop here. And then we talked about it before. You can see now IV under 50%, right? So pretty much back to normal, right? Slightly cheaper, but you can see the massive call volume versus puts. This again, kind of a sign of overexuberance to the upside. Call buyers rushing in, right? But being met with some selling of those calls, right? Because IV hasn't lifted. Previous time we saw this, we saw the IV lift because the call buyers were willing to almost pay any price. Here, we're seeing massive call buying, massive bullishness, but we're seeing, for the most part, sellers coming in, which I think, again, might favor a pullback on GDX going forward. Here is the basic 30-day, slightly out of the money, 40 delta negative put. As you can see here, the IV, here's that extreme. The last time GDX, as we said, was at the high back here, you saw actually IV hit an extreme and then pull back. Now with GDX making a fresh new high, we're actually seeing it drop, right? So we're seeing the IV at a much lower level, certainly, than it was back here. This makes option prices cheaper, favors option buying. To take a quick comparative, right, I simply pulled off the last time that GDX made that high in October, right, at 84.44, right? The $81 put, the slightly out of the money put, out of the money by a little over 2.5 points, right? Or, 3.5 points roughly out of the money, was priced at 268. So slightly out of the money put, about 4% out of the money, right? 21 days to expiration. The IV back then, as we said, at a pretty big, extreme here. As we said the last time, it was up here on the IV. Now, fast forward to Friday, you can see GLD is actually higher, right? So GLD, right, closed at 87.79 Friday. Compare that to the previous kind of high level, right? So GDX, excuse me, let's change that. Increased by over 3 points, 334. The $85 put closed at about $2.50, a touch more. So it's a little bit cheaper than the $81 put. However, it's less out of the money, over $279 out of the money, right? GDX closed at 87.79, the 85 put. 279 out of the money back here. GDX, and again, we'll change that to the proper one, closed at 84.44. That 81 put was over 3 points out of the money. So this one is less out of the money. You'd expect it to be higher price, right? Only 3% out of the money compared to over 4% back there. GDX is higher overall. You'd expect option prices, the higher the underlying, option prices generally, both puts and calls, increase, right? But you see that put actually a little bit lower in price, 268 before, 256 today, and days to expiration, 27 days to expiration now, right? So longer by a week, so you have more time. More time should be a more expensive option, but because IV is only a little over 42 now compared to over 52, that huge drop in IV from now till back last time GDX made a high, right, has dropped sharply, which means option prices have come down. So with a higher GDX, right, with less out of the money and more days to expiration, all those factors should mean a higher put price, right? But because IV has dropped 10 vol points, right, you're seeing the price of that put much cheaper, right? And you can kind of do a comparative, the price of the put, right, compared to the price of the GDX to kind of give you just a good comparative. So it's roughly 2.92% of the GDX. Back here, that same put, right, you can see, take the price of the put divided by the GDX, well over 3%. So put prices definitely cheaper, which sets up a couple trade ideas to position for a pullback in a defined risk way on GDX, which, as we said, overvalued from kind of a fundamental standpoint. All the major components are trading basically at the highest valuation multiples over the past 6 months. Definitely overvalued on a comparative performance to GLD, which normally was highly correlated. Lately, you've seen gold stocks, GDX, just rip higher, right? And now at an extreme, right? Over 86% extreme over the past 3 years. The last time it hit this extreme led to that big pullback, as we saw on the chart going back to last October. So certainly overvalued on a comparative basis, GDX, right? As we said, the technicals getting a little bit stretched, maybe not egregiously so, but certainly getting towards those overbought levels. And IV certainly at the cheapest level almost we have seen over the past month or so. And normally you'd expect IV to be higher given that it's at a new high on GDX. So couple trades, simple put buy, right? Just go out and buy those puts we are looking at. The January of next year, 16th, $85 put for 260. Simple trade. You're buying cheap IV on a comparatively overvalued, overbought, and certainly comparative to gold over valued GDX, right? Or if you want to sell a little premium and just kind of put on a trade where you defray a little of the cost, a put diagonal, buying again those Jan 16th 85 puts, but selling this Friday coming up, December 26th, 84 put for 40 cents reduces the cost to 220, right? And you're certainly still bearish, right, with that put diagonal, just looking for a pullback. And you can continue to kind of chop wood, as I call it, right? Here you can see that 84 put trading about 40 cents, but you have the January 2nd, 9th, and then the 16th with the expiration that we're buying to continue to sell option premium defray some of that cost. Or you can just go out and do a simple put vertical, right? Go buy the 85 put, sell the 83 put, and only pay 80 cents. Here, if you see GDX close below 83 come January 16th, that'll be worth $1.20, obviously. So that would be a very nice gain. So you'd be making $1.20, right? And risking 80 cents, the net cost that you paid for it, right? So it gives you a very nice return of 150%. So here's 3 ways to go about positioning for what we consider to be a probabilistic pullback, not only in gold, maybe somewhere along the way, but certainly GDX, which has gotten out a little over the skis compared to the price of gold versus normally. But as always, trading is all about probability, not certainty. So you can find the edge, put on the hedge, position size properly, and get out of the trade when losses get to a point where you're no longer comfortable with. Don't add to losers, as Paul Tudor Jones famously said, losers average losers. So until next time, as always, here's the good trade.